I'm speaking with Bryan High, Head of Global Private Finance at Barings. Bryan, first of all, thanks for joining us at Investment Leaders Forum.
Happy to be here and thanks for having me.
Bryan, you started your career in high yield before moving into private markets. How did you leverage, pun intended, your public market experience to be relevant against the bespoke nature of private credit? And how do you think about the interplay between syndicated markets and private credit today?
Sure. I think credit fundamentals and underwriting credit works in both public and private markets. That being said, I spent the bulk of my time in liquid credit, leading special situations and dealing with issues in the portfolio. So, you think about the average, in any point in time in the loan market, at most it's maybe 4 to 5% default rate. So I'm dealing with the bottom 4 to 5% where we're, changing documentation and really getting into what the documents allow for you to be able to recover on the collateral that ultimately is backing the loan that you're providing. And I think that informs quite a bit on the front end of private credit when you think about, our ability to influence documentation, particularly in the bilateral nature and club nature of the private asset class versus the broadly syndicated side of things. It certainly informs how you think about if this credit were to fall into that bottom 4 to 5%, how you would want it to be set up so that you can maximize recoveries. Because at the end of the day, this is sort of just a coupon clipping business and making sure that you're not losing money on the back end.
How has the middle market evolved and where are you seeing value globally?
Yeah, look, the middle market has evolved quite a bit, both in how people define it and then also what it looks like today relative to when private credit really took off post the GFC and banks stepping a little bit away from the corporate side of things. So when you think about previously the middle market being much smaller companies, today there's the upper middle market, the lower middle market, and the core middle market. We tend to focus on the core, but certainly the upper part of the market has gotten a lot of attention and is now starting to compete with the broadly syndicated market to win deals, which is influencing, frankly, the documentation that we just talked about, as well as spreads in the private credit market. As broadly syndicated markets have come back online and sort of roaring back with sort of lots of capital flooding in to get access to that income stream as rates increased and things stabilized. You started to see those focused on the upper end of the market competing both on a spread perspective and then also on a documentation perspective. That obviously has knock-on effects to the core middle market where we participate, but there is still a liquidity premium, and I think the documentation is set up quite well, relative to what we've seen at the upper end of the market. So it's really created a much larger private credit direct lending space. And there are pockets of where you can get certain terms versus other parts of the market where you can't get those terms.
You've said that capital preservation is rule 1 and 2. How does that philosophy show up in the way that you source, structure, and risk manage deals, especially in the mid-market where, as you say, you often hold the pen?
Yeah, this is an illiquid asset class. So, as we think about sourcing assets, we want to make sure we're partnering with management teams that we believe in and sponsors that we've, seen operate in difficult situations and that they are true experts in the various sectors that we may be focused on at any one point in time. And then, as you think about structuring, we talked a little bit about documentation, making sure that you can protect your collateral and that at the end of the day, you can recover on any troubled assets within the portfolio. So really focusing on, the underlying documentation, as you said, holding the pen and making sure that you hold a firm line in terms of it is a secured instrument that you're providing and that security is there and you can actually enforce on it should you need to in the future. And then from sort of a monitoring perspective, you want to make sure you have experienced and large teams to deal with your portfolios. Globally, we have over 350 portfolio companies that we currently finance today that are in the portfolio. It requires lots of bodies and eyeballs to stay on top of what's going on at each one of those private companies that are reporting at different times and have different trends from a seasonal perspective. So making sure that we're on top of that and able to make sure we identify any issues early and often so that we can deal with them in due course should there be any issues in the portfolio.
You talk about those sponsor relationships. They're obviously very crucial, but particularly they'd be the key to the access to the deals. So what makes Barings a preferred partner, even when others might be offering cheaper capital? How do you stand out in such a competitive market?
Yeah, it's a great question, Jim. I think our affiliation with MassMutual, our parent company, we're a wholly owned subsidiary of them. They're patient long-term capital. You think about life insurance, that's long-term capital that's looking at the next 10, 20, 30, 40 years in this business. And they've been in this business for decades already. So, having that consistency in the market and consistency of capital is certainly first and foremost, but also being as relevant as we possibly can be at Barings to that sponsor universe. Obviously, being able to finance their LBOs with, a term loan B that is senior secured in nature and looks like the rest of the market is something that they're going to expect from any direct lender. But the fact that we own an asset-based revolver business, that we have a $60+ billion high yield business that invests should they have portfolio companies that want to tap into the liquid markets. We have an opportunistic credit business. We have a fund finance business. Lots of ways that we can partner, not only with their portfolio companies, but with themselves as GPs from a financing perspective, makes us more relevant to them than others who maybe just have a single solution that they can offer. So I think taking a holistic view as a firm, but also, having a stable and consistent capital base is where we sort of lean to try to win.
You talked about such a broad and varied and disparate group of companies, but you largely avoid or totally avoid cyclical sectors and commodity-linked businesses. So is that sectoral discipline really the core driver of your returns? And how should allocators evaluate managers in what we've been talking about, a really crowded private credit landscape today?
Sure. I think what drives our returns is our focus on the core middle market, where we can continue to get a consistent illiquidity premium relative to broadly syndicated markets. And we've stayed true to that core middle market. Certainly that's part of it. I think the fact that our parent company who owns us takes a stake in every single deal that we do, we're effectively principal investors in every deal. So we're fully aligned from, making sure that we recover all of the capital that we lend out, and getting the best outcome for our investors, because we're also investing in each one of those deals. It's not just a fee game for us, it's also investing. I think that's another reason why we tend to stand out. And I also think from a diversification perspective, and you said, what should people be focused on? I think it's making sure that you're cycle tested, that you have the ability to deal with issues in the portfolio when they come, because spreads are spreads. And, if you have a big enough platform, it's difficult to differentiate from a spread perspective, especially if you're focusing on those sectors, as you mentioned, that have, a history of fewer defaults and better loss given defaults. And that's why we focus on those sectors, to try to set ourselves up really well on the front end. But then being able to deal with those issues with experience on the back end is super important. But also, as you think about from a portfolio approach as an investor, you're probably not choosing only one manager. You're choosing, one for the upper market, one for the core market, maybe even a lower middle market, maybe one in Europe, maybe one in North America, and one in Asia Pac. You want diversification. And I think one thing that people maybe fail to realize is quite a few of the managers, particularly in North America, as you sort of look across the landscape, have very similar deals, in some instances, the exact same deals across their portfolio. And being able to really, suss out how much of that is differentiated versus what you already have in another manager. I think that's where we tend to stand out quite a bit as well. It's a differentiated portfolio. We don't have a ton of overlap with other managers in the market.
I've been chatting with Bryan High, Head of Global Private Finance at Barings. Bryan, it's a pleasure talking and for having you at Investment Leaders Forum.
Thanks, Jim. Appreciate the time.